right, well, we're getting settled here. My name's Dustin Stolz. I'm a senior analyst with ADI. I'm going to be covering some of the key insights that we have regarding the upstream oil and gas sector. So as most of you probably know, 2022 was a good year for upstream oil and gas companies. We've seen the upstream companies are seeing record profits, almost nearing $1.5 billion, $1,500 billion in free cash flow generated globally. We see these companies, right, they're reinvesting this money back to, I shouldn't say reinvesting, they're allocating this money to clean up their balance sheets after years of accruing debt and everything. As investment rates were high, we saw and oil prices were low. We saw debt build over the years, and now oil company or the operators are investing more in paying down their debt and returning value to shareholders and upping their dividends. So that continues to remain a focus as they focus on investor returns. Uday touched on this several times in the talk this morning about upstream reinvestment rates. We've seen upstream reinvestment rates from, they used to be well over 100% back, before the price crash of 2014. And since then, they've steadily declined. And we're seeing reinvestment rates, remaining near historical lows. And policymakers and such are, through windfall taxes and other initiatives, are not really encouraging future investments. We see things like, I'm sure you're all aware of what's going on in Europe with some of the windfall taxes. ExxonMobil is actually suing the EU, and they said they're going to factor in these taxes when considering future investments. Harbor Energy is actually laying people off. We're seeing TotalEnergies there cutting investments, and Shell and Equinor have straight out said that, right, we're gonna have to reevaluate our decisions going forward. Some response, though, we're seeing a little bit of mixed response because UK's latest North Sea leasing round drew 115 bids. So they're still seeing activity, though, in the leasing rounds, and 76 different companies. So there's quite a bit of activity going there. And Norway is still awarding contracts. In their latest exploration license, they assigned 47 new offshore contracts. So the exact fallout of these windfall taxes is not completely known, but those kind of policies and that kind of activity is not encouraging for future investment for the industry. Uday also touched on this earlier as well. We're seeing new well productivity is falling, indicating that Tier 1 acreage is depleting. On top of that, we're seeing shale companies, especially ones out of the Permian, starting to reforecast and pull back their forecasts. Pioneer has said their total production, what they see for the Permian Basin in 2030, they've pulled it back from 8 million barrels to they think it's going to be 7 million barrels a day of production in 2030. ExxonMobil revised their forecast down from 25% to 20% production growth, and Chevron is making predictions. They're calling at the lower end of their forecast. So all this saying, Chevron and Exxon in particular, they both have pretty ambitious and robust targets targeting 1 million barrels a day of production out of the Permian. Those targets are likely going to take more capital than what was originally anticipated, and it's going to be a harder target to achieve. What else we're seeing in the upstream industry is shale plays and elsewhere. We're seeing a strong preference for artificial lift and ESPs in particular. Part of the drive for this is the reduced upfront cost for ESPs. We're also seeing improved infrastructure that's allowing more electrified type artificial lift into play. However, we're also hearing about lower formation pressures as a driving factor in this, and this is happening as shale plays are becoming more and more mature, requiring more assisted lift. We also noticed there was a big deal several years ago when private drilling actually overtook public drillers as the majority of the rig count. Well, we're not there yet today, but what we noticed, at the back half of 2022, the rig count kind of just stabilized, but that almost happened really at the expense of the private operators. Private operators pulled rig activity back a little bit while the public's pulled forward, and we've seen that percentage change from the rig count from the public rig count in August of 2022 was about 38%, and that's increasing to 44%, so we're getting closer and closer to that 50-50 mix. And our last thing is, Carbon sequestration is becoming a big deal and a big topic in the industry. What we look at today, though, when we look at the most use for utilization today, is for upstream and EOR use. They make up a majority of the projects and majority of the utilization. Going forward, though, as we look at projects coming down the pipeline and what usage, right, that's being geared towards other usage, largely storage, and we're seeing a lot more of that application. That what's coming down the pipeline is coming from downstream activities. So in summary, right, the highlights we see from the upstream industry are operators are making record profits and they're prioritizing investor returns. Upstream is continuing to be very prudent with their capital, keeping their reinvestment rates low, and policy around the world is not really advocating for further investment. That being said, right, we do see growing investments, but it's being held back by policy. Lower well productivity and some of the advice coming out of the forecast coming out of shale companies is suggesting, right, top tier shale acreage is running out. Artificial lift is rising, and private companies are pulling back as public companies are pulling forward on the rig count. And lastly, right, CCUS is becoming a big deal, but more of that utilization now is going to be moving away from EOR into storage and other activities. And with that, I'll turn it over to the panel here.
Thanks, Dustin.